Good morning, guys. Welcome to Mug Briefing. Amazon just told investors it plans to spend an extraordinary amount of money next year, and the market reacted immediately. In simple words, the company says it expects to pour about $200 billion in capital spending in 2026, mostly into cloud computing and artificial intelligence infrastructure. Investors heard that number, worried about how it affects near-term profits and cash flow, and sold the stock sharply. That sudden tension between building the future and protecting today's returns is why this matters right now. The disclosure came during Amazon's early February earnings report and outlook. Management, led by CEO Andy Jassy, told investors the company projects roughly $200 billion in capital expenditures for 2026, up from about $131 to $132 billion in 2025. Capital spending, or CapEx, means long-term investments in physical and technical infrastructure, data centers, chips, networking equipment, robotics, and the systems that power Amazon Web Services, known as AWS. According to Reuters and Bloomberg reporting, the surprise scale of that projection triggered an immediate market reaction. Shares fell about 11.5% in after-hours trading, and the stock traded notably lower the following session as investors digested the implications. This is a projection, not a signed contract. Companies revise spending plans all the time, but it is an official guidance number given to investors, not a rumor. Management framed the increase as a deliberate strategy to expand AI and cloud capacity at a time when global demand for computing power is surging. The jump is large, even by Amazon standards. A nearly $70 billion increase year over year is unusual and sits well above what many analysts expected, which helps explain the shock in the stock price. The earnings report itself was not the central problem. Market coverage points to the CapEx guidance as the primary driver of the sell-off. Investors were not just reacting to the size of the number, but to what it implies. When a company spends heavily upfront, cash flow gets tighter in the short term. The returns from that investment arrive later, if the projects succeed. The market is essentially debating timing, how long shareholders must wait before that $200 billion turns into higher profit. Amazon did not publish a line-by-line breakdown tying exact dollar amounts to AI versus other infrastructure. Reporting describes the spending as heavily concentrated in AWS and AI capacity, but the precise allocation is not public. Investor fears about cash flow are based on basic financial math, not a hidden warning from Amazon. If spending rises faster than operating cash flow, free cash flow narrows. The company did not say profits will collapse. The market is inferring pressure, not reacting to an explicit profit warning. Why do this now? The simplest explanation is competitive acceleration. The largest cloud companies, Amazon, Microsoft, Google, and Meta, are in an arms race to build AI infrastructure. Training and running modern AI systems requires enormous data centers, packed with specialized chips and high-speed networking. Demand for that capacity is growing faster than traditional cloud expansion. Amazon appears to be choosing speed over caution, betting that capturing AI market share early is worth the financial strain. This likely means Amazon is prioritizing long-term dominance over short-term comfort. Supporters would argue that infrastructure leadership compounds. The more capacity you build early, the more customers you attract, which funds the next expansion. Critics point out that heavy capital cycles can overshoot, leaving companies with expensive assets if demand slows. Both views can be true at different points in history. The uncertainty is what markets are pricing in. The immediate impact for Americans is mostly financial and industrial rather than personal. Millions of retirement accounts and index funds hold Amazon stock, so large swings in prices ripple through portfolios. At the same time, this level of infrastructure spending fuels construction, chip manufacturing, networking equipment, and power projects that can support jobs in engineering, logistics, and data center development. For AWS customers, more capacity could eventually mean faster services and fewer bottlenecks in AI computing, though pricing effects depend on how Amazon balances expansion with profitability. For investors, the exposure is straightforward. Heavier spending today means lower near-term free cash flow, which can weigh on share prices. It does not mean Amazon is running out of money or facing insolvency. The company is choosing to reinvest aggressively. A stock drop reflects disagreement about timing, not proof that the business is failing. Amazon is not abandoning retail. It is expanding the infrastructure that increasingly underpins both retail and cloud operations. What happens next will likely revolve around credibility. Analysts will watch whether AWS growth justifies the pace of spending. If revenue and margins expand alongside the new infrastructure, investor confidence may stabilize. If spending rises faster than returns materialize, pressure could continue. Amazon could adjust the plan, finance projects through debt, or rebalance buybacks depending on cash flow conditions. Other hyperscalers may match the escalation, which could keep the entire tech sector volatile as markets reassess how much AI investment is too much. The situation becomes more serious if Amazon begins missing cash flow expectations, if credit agencies react to financing needs, or if suppliers report strain meeting orders. Those would suggest the expansion is stressing the system. Right now, the story is about scale and timing, not financial distress. In essence, Amazon told investors it's doubling down on the future of computing, and the market responded by asking how expensive that future will be before it pays off. The company is betting that AI infrastructure is the next foundation of global technology. Investors are deciding how much patience they have for that bet. Neither side is declaring defeat. They're negotiating in real time the price of long-term ambition.